Okay, we're continuing our discussion with Chapter 3 regarding the balance sheet and financial disclosures. Now we're at the point where we're going to start to analyze financial statement information. Investors and other users are often interested in looking at financial statement information, which can be historical, to help them determine what the outlook for the company is in the future. Often they're concerned with things like default risk, which is the risk that the company cannot pay its obligations, or operational risk, which relates to how a company can withstand various different events. When we do financial statement analysis, there's a number of different methods that we can use. For instance, we produce comparative financial statements. Each year, we don't just show the current year's financial statement information, but we might show the previous 2 or 3 years historically so that we can compare from one year to the next and look for trends. One way to highlight these trends is to do a horizontal analysis. A horizontal analysis will compare a prior year to a current year information and look to see the percentage of change year over year, using the prior year as a base amount. This is often the starting point for risk analysis when we do something like an audit. We can also do a vertical analysis. A vertical analysis might compare a line item on the financial statement to a total on the financial statement. For instance, a percent of assets. You might wonder how much the cash balance is as a percent of total assets, and that would be a vertical analysis. Whereas a horizontal analysis might say how much was the cash balance this year, current year, compared to prior year, last year, and we might calculate a percentage change, which is where you get that percentage of base year amount. A ratio analysis is also a common way for us to formulate predictions on where the future of the company is going, and that's what we're going to focus on in the remainder of this chapter. The first set of ratios that we're going to look at are liquidity ratios. Liquidity refers to the readiness of assets to be converted to cash. There are 2 common liquidity ratios that we're going to look at. 1, current ratio, and 2, the acid test or quick ratio, are commonly used to help us determine the liquidity of a company. We calculate current ratio, as you can see here, as current assets divided by current liabilities. Remember that current assets are assets that are going to be used up or turned into cash within 1 year or less. Current liabilities are liabilities that are going to mature within 1 year or less. Therefore, this ratio helps us determine in a comparable format whether or not we have enough assets to be used in the current year to pay off the liabilities that are coming due in the current year. The acid test or quick ratio is just a more conservative approach to calculating the current ratio. So we'll note right now that it's more conservative, and I'll show you the calculation here in a minute. But basically what we are doing is only including in the numerator certain types of current assets. We don't include all current assets, but certain types of current assets that are more quickly able to be turned into cash or perhaps already are cash, thereby giving us a more conservative approach to whether or not we truly have assets that can be used up in the year to pay off the current liabilities that are coming due within the year. Okay, an example over here of a current ratio indicates that Nike reports current assets of $15 billion and current liabilities of $6 billion. So they calculate the current ratio of current assets divided by our current liabilities, and they get 2.52. Remember, anything over 1 indicates that a company at least has enough current assets on hand to pay off the current liabilities that are coming due on hand. Another way that we could look at this is by calculating what we call working capital. Working capital is calculated as current assets minus current liabilities. The acid test or quick ratio, as we previously mentioned, is a more conservative approach to calculating the current ratio. It excludes certain current assets from the numerator. For instance, inventories are excluded. Remember that some companies might have a slow inventory turnover, and you have to remember that current liabilities, they have payment terms. So what if the payment terms are within 30 days, but your inventory doesn't turn over within 30 days? Well, then your inventory effectively wouldn't be able to satisfy the current liabilities that are coming due. So to take a more conservative approach, we exclude inventories from the numerator. We exclude prepaid items because remember, you traditionally settle your maturing obligations with cash, not with cash that's already been spent like prepaids. We exclude restrictive cash, which is used for certain types of payments. We use it for certain purposes, so we restrict the cash to not be used for general liabilities, and therefore it's excluded. We also exclude deferred taxes, which are going to be talked about in a subsequent chapter and also serve a very very specific purpose. But what we include in the numerator is cash, short-term investments, and accounts receivable. All of these are expected to be usable within the short term and therefore can be used to satisfy maturing liabilities. So this conservative approach gives us a lower current ratio because items are specifically excluded from the numerator and therefore tells us a more realistic indication on whether or not the company can satisfy its short-term debt. So in this example, we had Nike's quick assets, which are $9,282,000,000, and this is pulled directly from the balance sheet, which we just talked about in previous portions of the chapter on how to prepare. And then that information is divided by the current liabilities. So we have the quick assets, which again are the cash, the short-term investments, and the accounts receivable divided by our current liabilities. In order for these ratios to make sense, we really need to compare them to something. Usually that comparison will take place either to the industry, to a competitor, or to the company itself, meaning comparing prior years to the current year. Here, in comparison to the industry average, which has a current ratio of 1.41 and an asset test ratio of 1.12, we can see that Nike looks pretty liquid. Generally, anything over 1 with these ratios implies that the company's in decent shape, but you always have to compare that in consideration with the context of the industry or competitor or the company itself, for instance, if it starts trending downward. The other thing that you want to think about is just because a company has a ratio over 1 does not necessarily imply that it's going to have the ability to satisfy its short-term debt. For instance, if its current ratio was over 1, but its asset test ratio was not, this could imply that some of the current assets can't be used to satisfy short-term debt. The other thing you have to remember is just because a company's current ratio or asset test ratio is under 1 doesn't mean that it couldn't also take on future debt to satisfy the short-term debt and therefore raise its liquidity. The other final thing to remember is just because a company has a ratio over 1, it doesn't necessarily mean it's a good thing if it's too high above 1. That might mean that they're keeping too many current assets on hand and not effectively employing their use of cash. For instance, investing in research and development or other long-term assets. Overall, what you want to remember is each of these ratios give us one data point that we should then consider in the context of all the data. And as we examine that data, we look for red flags. For instance, in the context of a current ratio or asset test ratio, those ratios that are underperforming with the industry or underperforming with a competitor or trending downwards or perhaps just simply below 1. Okay, let's go ahead and try a multiple choice question. You can pause this and we'll come back together and look over it. Okay, this one says, which of the following transactions would increase a company's liquidity ratio? A says cash received from customers on accounts receivable. So this increase to cash would increase a current asset, but we would decrease accounts receivable, another current asset, thereby netting the result. So that wouldn't change our current ratio. Here it says purchase office supplies with cash. This is the same sort of situation. Office supplies goes up, cash goes down, and therefore we have a netted result. Here we have paid dividends to shareholders. We have a decrease in our current assets from the cash going out and a decrease in stockholders' equity, but this would not increase, which is what we're looking for, the current ratio or the liquidity ratios here. The last one says we borrow cash by signing a 3-year note payable. Here we increase our current asset and increase a non-current liability. And because we're not increasing the denominator as well, then we do in fact have a change for the positive, an increase in the liquidity ratio. Whereas liquidity ratios helped us determine the future potential of a company to satisfy its short-term obligations, solvency ratios helps us determine the future potential for a company to satisfy its long-term obligations. We have two different ratios, again, that we're looking at. The first one is the debt-to-equity ratio. The second one is the times interest earned, or the TIE ratio. Each one of them help us determine a company's ability to pay its long-term debt. The debt-to-equity ratio takes total liabilities, including both current and non-current, and dividing by total shareholders' equity, including retained earnings. This helps us essentially determine how much of assets is financed by debt and how much is financed by equity. And this would then help a user of the financial statements, in particular a creditor, who might be interested in knowing how much debt was taken on in comparison to another company, to see if it's likely whether or not they would be paid back if the company were to default on their debt. Times interest earned ratio takes net income and adds back interest expense or income taxes. And depending on the type of multi-step income statement that you're looking at, we often refer to this subtotal as simply EBIT, which is earnings before interest and taxes, and then divides by interest expense. Essentially, what this ratio is designed to convey is the number of times that a company could cover its interest expense. And that would give an indication of whether or not the company could take on additional debt. Again, trying to give an indication of whether or not they're likely to pay their long-term debt. As indicated in the last slide, the debt to equity ratio helps us determine the reliance of a company on creditors, and it gives creditors an indication of their protection if the company were to default. So if the company were to go bankrupt, is it likely that the creditors would get their full repayment of the monies loaned? All things equal, the higher the ratio, the higher the risk that the creditor is taking on, that if the company is unable to meet its obligations, this individual creditor will not be paid in full. Again, looking at the example of Nike, they have a debt to equity ratio of 0.7 after pulling that information from the balance sheet. In order to help us put this in context or perspective, we compare that back to the industry average. What we find is the industry average has a 0.95 ratio. Nike's is 0.7, so they have a lower default risk. Now, does this necessarily mean that Nike is in a positive position? The answer to that is possibly. They do have a lower default risk, and so from a creditor's perspective, that might be a positive thing. But one thing that you have to understand is that a company can utilize debt in order to magnify results or returns for shareholders, particularly when things go positively. And so this may be an indication that Nike has a lower default risk, but it also could be an indication that Nike is underutilizing debt. And we're going to look at this at the end of the chapter. The times interest earned ratio is often used in conjunction with the debt to equity ratio. Again, it's calculated by taking our earnings before interest and taxes and dividing by interest expense. And essentially, it's a ratio that tries to give an indication of how many more times we could pay interest that's coming due with the earnings available to cover interest. And so we say if those earnings are many times greater than the interest expense that we have, then creditors' interests are better protected. Again, if we look at an example from Nike, we see that they have net income. They've added back interest expense and income taxes here. This gives us an indication of their earnings before interest and taxes. Again, you'll commonly see this on financial statements as EBIT. And then we take that and divide by the interest that we have, and this gives us an indication of how many more times we could cover interest expense. And again, that would tell us whether or not we could take on more debt, or whether or not at least the creditors right now who have debt outstanding with us would allow us to cover their interest payments that we owe them. Okay, let's look at a quick multiple choice example. You can pause this and then we'll come back to look at it together. Okay, this problem says that Geisner Inc. has total assets of $1 million and total liabilities of $600,000. They give us an industry average for the debt to equity ratio of 1.2. They want us to calculate our debt to equity ratio and indicate whether or not we're in a better position as it relates to default risk. So if we set up our accounting equation, assets equal liabilities plus stockholders' equity, and we plug in what we know, we have $1 million over here, we have 600,000 over here for liabilities, and we don't know X. So we'll say that X, or stockholders' equity, is equal to 400,000. Now that we've solved for this, we'll go ahead and calculate our debt to equity ratio, which again is our debt or our liabilities over our equity, which includes our retained earnings for stockholders' equity. And this gives us a total of 600,000 over 400,000. And this would provide 1.5 as our debt to equity ratio. In comparison to the ratio that they give us for the industry, which is 1.2, we would state that our 1.5 has a higher default risk. So our answer to this would be C. As we discussed, there are default risks associated with borrowing or taking on debt, but we can also utilize debt to magnify results for shareholders and produce greater returns when we have a favorable circumstance. The question becomes, what is our return on assets versus what is our cost of borrowing? And so let's look at a couple examples of how this can actually impact shareholders. First example says that a newly formed corporation is trying to determine the appropriate mix of its two ways of funding assets, debt or equity. They indicated that their goal is to raise $50 million, and they've narrowed it down to just two options. One is to have $10 million in debt and $40 million in equity, and the other is to have $30 million in debt and $20 million in equity. They give us income before interest and taxes at $8 million, and they indicate that their interest rate on debt is 8%. The income tax rate is 40%. Notice in both circumstances, alternative number 1 or alternative number 2, our income before interest and taxes is $8 million. This implies that we had a 16% return on assets. We had assets of $50 million multiplied by 16%, and that produces for us $8 million. Notice that this 16% return on assets is greater than the interest rate that we were incurring, which is 8%. This implies that we have a favorable financial leverage situation. And again, financial leverage is this idea where we can use debt to magnify results. If you notice, our calculation for interest expense, it simply differs based upon the amount of principal that was borrowed. Here you can see that alternative number 1 produced $4,320,000, alternative number 2 produced $3,360,000. And you may think at first glance, well, the more favorable result was actually alternative number 1, which used less debt. But understand, from a shareholder's perspective, if you look at the return on shareholders' equity, then you find that alternative number 2 is actually more favorable because they took on less equity. Again, they mixed their equity with more debt, and once they were able to return an asset return above what the interest rate was, they were able to magnify the return on shareholders' equity for the better. On alternative number 2, you had shareholders' equity return with a 16.8%. And alternative number 1, although it had higher net income, it had more shareholders to split that income among. And therefore, the return on shareholders' equity was only 10.8%. But understand that financial leverage can also be unfavorable. Here we have the exact same situation, but this time they indicate for us the income before interest and taxes was only $3 million. This implies that the company had a 6% return. So 6% regardless of whether or not you're looking at alternative 1 or alternative 2. In that scenario, this 6% return is less than the 8% that it took on for debt. And therefore, you can see that now our shareholder equity return has switched, and alternative 1 is the more favorable return. The idea is that financial leverage is neither good nor bad. It simply magnifies results, and you have to consider the risk with the return that can be generated for shareholders in taking on that risk.